Moves and how to invest in the current environment are Quincy Crosby, Chief Investment Strategist at the Hartford Group, Harry Rady, CEO and Portfolio Manager with Rady Asset Management, and Jim McCowan, CEO of Principal Global Investors. And welcome to the program, gentlemen. Thanks for being with us ahead of the big weekend. Jim, let's just kick things off with you. What turned things, in your view, in today's activity, and why, or what can we take away from that going into next week?
The talk about following the UK downgrade, they talk about US credit given higher debt levels and the higher government debt levels that result from the financial crisis clearly has got to market sentiment in the last 2 or 3 days. I think that's a bit overdone because if you're going to sell the dollar on the back of higher debt levels, what are you going to buy? And both Europe and Japan are facing enormous problems with declining exports, which will hit their growth and hit their trade balances. So I think that there has been a little bit of a knock from something that will turn out to be a pretty short-term fear. I think the market on balance has behaved pretty well, given negative news on and given negative developments on credit, on the economy, and the enormous volume of issuance.
Quincy, what's your take? Do you see the market being under pressure going forward into next week, or is there reason for optimism moving forward?
Next week is an important week. We're going to have a lot of supply going into the market, and you'll notice on days that the supply cannot be absorbed, we'll see rates moving up, we'll see the equity market selling off. We also have residential news coming out. It's a very heavy news flow week, and I think the market's going to respond to that.
Harry, how about this question about General Motors going forward? We saw a major sell-off into the last moments of trade today in GM shares. We're hearing these words that maybe they're going to be pushed into filing for bankruptcy sometime next week. How important is that to the way things trade going forward?
Well, I think a more important issue is the bond market as it relates to the equity market, and we see a real lose-lose situation. You know, the bond market has really backed up, and you combine that with the fact that the equity markets are up 40%. And this is in the face of an aggressive debt buyback program from the Treasury. So basically they're running out of ammunition, and we're very concerned. We see this as a bit of a shell game. They buy back debt, but then they issue significantly more. And I think that the market is starting to price in a risk premium, and we think that if rates continue to back up, that the market goes down. And And so we just see a lose-lose.
To follow up on that theme, Harry, this breaking of the buck has certainly played a role in reflating the overall market. Has it done enough at this point? Is it time to put measures into place that will improve the dollar versus other foreign currencies, or do we need to see more reflation before that can be done?
You know, I'm a believer in just letting the markets, you know, do what they do. But, you know, our job is really to look for opportunity. And where we see opportunity right now is in cash and shorting stocks.
American cash, U.S. cash.
Absolutely. You know, we just think we're holding the highest amount of cash we've ever held in the history of the fund. And we're short GAMCO. GAMCO's trading at 65 times earnings, 30 times cash flow, and it is up twofold in the last 90 days. We just don't understand it, and we're short GBL.
Quincy, how about you? What's your trade right now?
We like the energy complex. We also like materials and tech names. But I will tell you, because of what we just heard, you have to look at the pro-cyclical currencies, in other words, the commodity currencies.
All right, Jim, last question over to you. What are you doing right now? What's your top position?
I'd be on the other side from Harry. I'd say that credit is easing up and that the economy is showing all the signs of the beginning of the end of the recession. And with credit easing up and inventories turning from inventory declines to inventory rises, I think you're going to see the economy steadying up in the second half of the year, and that will mean it's time to accumulate equities. I'd avoid commodities because I think structural demand is very bad. They've been pushed up by financial operations. I'd avoid the whole healthcare complex because I think that the president is getting real about removing the waste in U.S. healthcare, which is 16% of GDP, compared with 9 or 10% in other developed countries who get a better outturn. So there are areas I'd avoid, but I think in general equities are worth accumulating.
All right. Thanks so much, Jim, Quincy, and Harry. Y'all have a great weekend.
Yeah.
Thanks, Rebecca.
Thank you.
Thank you.
President Obama signing the